Stop looking at the price. Right now, as headlines scream about Bitcoin's collapse and the entire internet is fixated on the chart, you are being distracted. Bitcoin price is one of the most searched financial topics in the world, while fear indicators are hitting extreme levels. But the price is the least important part of the story. The real crisis is happening in the plumbing of the system. A financial crisis does not begin when prices fall. It begins when money stops moving. Right now, we are watching a real-time simulation of how financial markets break. In a true crisis, the number on the screen becomes a fantasy. What matters is whether you can actually get your money out. Millions of investors learned this lesson during the GameStop event in 2021. Retail traders pushed the stock price to extreme levels and the system buckled. Brokerages like Robinhood didn't just slow trading, they turned off the buy button. This was not a conspiracy. Clearinghouses demanded billions of dollars in collateral that brokers did not have. For millions of investors, the loss was not price volatility. It was the total inability to act. It was the sudden realization that access to their own money was conditional. The doors to their money could be locked from the outside. On this channel, we do not watch price. We watch plumbing. This crash is a live fire drill for the financial system. It shows what happens when the promises of modern finance are tested. And it all comes down to three things: access, settlement, and counterparty risk. When markets crash, most people search for a single cause. But major crashes are never caused by one event. The crash is the symptom. The disease is leverage unwinding. For months, Bitcoin markets were supported by a popular institutional strategy known as the basis trade. Large hedge funds were buying Bitcoin through ETFs, while simultaneously selling Bitcoin futures contracts at higher prices. This allowed them to capture low-risk profits from the price difference. The trade created massive and steady demand for Bitcoin. By early 2026, that trade became less profitable. Large funds began unwinding positions. They sold ETF shares and closed futures contracts. A major pillar of demand disappeared at the same time global markets shifted toward risk-off behavior. This selling hit a market with weak liquidity. There were not enough buyers. This triggered forced liquidations. Exchanges automatically closed leveraged positions that could not meet margin requirements. Forced selling pushes prices lower, triggering more liquidations, creating a self-reinforcing death spiral. The price chart is not the story. It is the footprint of the real predator. The real story is liquidity failure. During liquidity crises, the most important question changes from what an asset is worth to whether it can even be sold. This brings us to the first pillar of financial crisis: access. In normal times, we assume access to our money is guaranteed. A crisis is when you discover it is not. During peak selling, exchange order books became thin. Market depth disappeared. Selling large positions became impossible without collapsing price further. When exits become crowded, investors do not lose money gradually. They lose control instantly. At the same time, exchanges slowed down. Websites froze. Logins failed. This is not conspiracy. Systems simply became overwhelmed as everyone rushed to exit simultaneously. This pattern exists across all financial markets. When Silicon Valley Bank collapsed in 2023, depositors experienced digital bank runs. Websites stopped functioning, transfers were frozen, access to money simply disappeared. This crisis spread into crypto when USDC lost its dollar peg and dropped to 87 cents. The stablecoin lost stability because part of its reserves were trapped inside Silicon Valley Bank. Stability disappeared because access disappeared. The first lesson of financial crisis is simple. Wealth only exists if it can be accessed. Banks, brokerages, and exchanges are strongest during calm markets and weakest during panic. But even if you can sell an asset, another hidden risk appears: settlement. Most people believe transactions are instant. They are not. Stock trades operate on delayed settlement. When you sell a stock, the transaction may take an entire business day to finalize. During that delay, counterparties can fail and brokers can collapse. Clearinghouses guarantee trades by requiring collateral from brokers. When volatility spikes, collateral demands rise. Brokers unable to provide collateral can be forced to restrict trading, turning invisible settlement risk into visible access failure. Bitcoin provides final settlement on-chain. Once confirmed, transactions cannot be reversed and do not require intermediaries. However, most users interact through centralized exchanges. During crashes, deposits slow down. Withdrawals take longer. Even though the blockchain continues operating perfectly, access to traditional money becomes delayed. Financial systems are only as strong as their weakest link. Transactions are not complete when you click sell. They are complete when assets are securely in your possession. Crisis risk spreads through contagion. Liquidity withdrawal in one market forces selling in others. The sequence repeats across history. In 2008, banks stopped lending when mortgage assets collapsed. During this Bitcoin crash, hedge funds unwound leveraged strategies. The pattern is identical. Liquidity disappears first. During panic, capital rotates away from risk assets and toward cash and government bonds. This is not speculation. It is repeated human behavior during stress. Private credit markets represent another hidden risk. If those funds face defaults, they cannot sell illiquid loans. They are forced to sell liquid assets like stocks, bonds, and crypto to raise cash. A crisis in an unfamiliar market can become forced selling inside your portfolio. And when institutions need liquidity simultaneously, the final risk appears. Counterparty risk is the danger that the person on the other side of your transaction cannot fulfill their obligation. Before 2008, deals with large banks were considered safe. When Lehman Brothers collapsed and AIG nearly failed, the world learned that trusted counterparties could be insolvent. Crypto markets experienced similar failures with Mt. Gox, Celsius, and FTX. FTX appeared trustworthy, but secretly gambled customer deposits. When losses appeared, customer assets were gone. Bitcoin ETFs reduce exchange counterparty risk, but introduce new risks. Investors no longer hold Bitcoin directly. They hold shares in funds controlled by custodians and clearing systems. ETF investors depend on stock markets, brokerages, and clearinghouses remaining operational. Solving one counterparty risk introduces exposure to another. Financial crises force investors to ask one critical question: who holds my assets? And what happens if they fail? The next time markets crash, ignore the price. The real signal appears in system stress. Watch for slowed withdrawals, settlement delays, and rumors of institutional failures. Your wealth depends on three pillars: access, settlement, counterparty solvency. Understanding these pillars determines whether you survive financial panic or become trapped inside it. If someone you know is still focused only on price, this might help them see the bigger picture. I want to hear from you. Has a withdrawal delay, trading restriction, or custody scare ever impacted you more than price movement? Share your experience in the comments. Stay safe and stay informed.